Okay, let's go ahead and get started. I just wanted to first thank everyone for joining us for this tax loss harvesting session. We are really excited to just share everything that all the knowledge we've gained from building this new feature into PortfolioPilot. And so, yeah, thank you for joining, and let's go ahead and get started. So the first thing, just to give you a quick agenda, if you're not familiar with Global Predictions, we're just going to give you a quick run through of who we are and what we do. The next thing, and this is really the big chunk of this session, is really trying to explain just tax loss harvesting to everyone, why it's important for self-directed investors. You know, one of the questions maybe all of you are asking is, do I qualify? Also just getting into the thing of what is tax loss harvesting, understanding capital gains, and then also going through some Canadian and United or US guidelines and examples as well. With all of that too, we also want to spend just a little bit of time at the end to just give you a quick demo of PortfolioPilot's tax loss harvesting feature. And then if time permits, you know, we'll open it up to Q&A, and if anything, we also have other opportunities to ask questions as well. So as we get started with this, one thing I just want to say, I know everyone is muted. If you have questions as we're going through this, feel free to add them to the chat, and I can always bubble them up. But yeah, let's go ahead and get into who we are. So Global Predictions, we are building the world's first commercially available digital twin. And this is going to hopefully power the next generation of decision-making for investors, for multinational corporations and government agencies. The recommendation engine that we built powers PortfolioPilot, which is our individual wealth management platform that empowers investors like you to feel more confident in improving their portfolios. So if you haven't used it already, one thing you'll know is you can see all of your assets in one place. You can find opportunities find opportunities to improve your expected returns and also minimize risk. We also have, from our recommendation engine, you can act on these automated recommendations and forecasts. And then most exciting is now you can actually tax loss harvest as well with this new feature. Just to give a little bit of background, so my name is Ben Johnson. I'm the head of marketing at Global Predictions. And then who I have joining us is Reed Hartman. He's our co-founder and head of quantitative economics at Global Predictions. He's an experienced investor with deep expertise in building these quantitative financial models. He spent 5 years at Bridgewater, which many of you might know is the firm is widely known for its best-in-class macroeconomic insights and investing. And then he also led development and portfolio oversight at True Signal, which is a New York-based hedge fund based around extracting fundamental insights from non-traditional data sets. He holds a bachelor's in economics and computer science from Dartmouth, and then he also has an MBA from London Business School. So everyone, this is Reed Hartman. And then the last thing I just wanted to preface before we kind of start is this session is for sure just educational purposes only. We do not offer advisory or brokerage services, nor do we recommend or advise investors to buy or sell particular stocks, securities, or investments. So just a heads up. And I'll let Reed take it away.
Thanks everyone for joining. So as Ben mentioned, you know, I've spent most of my career thus far at hedge funds. And one of the reasons that I wanted to build PortfolioPilot is because I realized, you know, a lot of investors don't actually do a great job in their personal portfolios. I mean, myself included when I was first getting started, and particularly with technical details like tax efficient investing, which is, you know, quite frankly, seems quite boring, but is really important as you start to learn the ropes. So today we're going to walk through some high level investment principles to basically negate taxes on capital gains in Canada and in the US. To just note that I'm not going to be giving specific, you know, personal tax investment advice. We'll cover mostly examples with federal taxation, The good news is that no matter what province or state you're in, the principles will basically be the same. You'll end up just paying a little bit more if you do have capital gains to pay in most places. So you can think about this as, if it works for federal, it'll probably work a little bit better for you in practice. We're not going to be talking about how to actually file the taxes. Again, this is mostly focused on what the concrete steps that you can take are in your investment portfolios today to put yourself in a position to do that well. And, as Ben mentioned, we'll also talk about some tools like the one that we're working on to hopefully make this a little bit easier. So if I do lose you, which hopefully I don't, there's definitely a lot of resources available to sort through tax loss harvesting as you sort of go forth and implement it in your own portfolios. Okay, so before we talk about what this is, why is it important? So basically, tax loss harvesting is a way that you can actually just save money today. And the longer you can keep money in your investment accounts and not have to pay them out to the government, the better. It can compound on itself and earn you more money in the future. I think we all like that. I don't think I need to explain that much more. You can also find ways to rebalance your portfolio tax efficiently if you're aware of how all this works, which will just help you, again, sort of build that nest egg as you go. And then I think the important other point here is that, you can literally do it yourself. So there's a lot of people that are obviously willing to do this sort of thing for you, like wealth managers and robo-advisors. But we think you can, by and large, get the benefit without having to introduce an intermediary if you just understand a couple simple principles. And so hopefully that will be clear as we go through. So what is tax loss harvesting? It's very simple in practice, or in principle. It's just about using your losses in your portfolio to offset your gains. That'll be within the same calendar year. And that way you won't have to necessarily pay capital gains tax for a particular period. So it's basically as easy as the slide shows, except for there's some simple calculations and nuances that we're going to walk through, such as, how do you choose your securities? How do you size the trades to offset one another? That kind of thing requires a little bit of arithmetic, but nothing that's that much worse than that. So hopefully you guys are all interested in this, but if you're sitting there wondering, do you qualify? The answer is probably yes. You need to be invested in public markets or have some way of selling a security with relative ease, so something that is fairly liquid. And you need to have, basically at least something that's gone down since you bought it. And that needs to be in a taxed account. So one thing off the bat is if all of your investments are in like retirement accounts, like IRAs, 401ks for you Canadians, are RRSPs and TFSAs, which is a bit of a mouthful to all say at once, then those investments you can't use to harvest, and you can't, obviously you're not paying capital gains on those unless you do an early withdrawal or something. So for the time being, we're going to ignore those. If you do have those accounts, it becomes important for one nuanced reason, which I'll get to later, but I'll point that out. So the universe that we're talking about right now is just all of your taxed investments. I should also point out that there's a couple special situations here. So if you fall into those, you might want to get a little bit more detailed guidance. So if you are a day trader, meaning like you get most of your income from investing on your own, not from a job or consulting or what have you, you're just going to have slightly different regulations in the US and in Canada. And if you've done something like sold a home or whatnot, then some of the tax details get a little bit more nuanced. I don't mean in general, I mean in this calendar year. So the good news, though, is that, good and bad news, this has been a tumultuous year for markets. So there's probably a lot of opportunity to sort of look at your portfolio and think about, that thing's gone down since I bought it. Maybe I should use that to harvest, or I actually sold that at a good time, but now I have a capital gain. So what should I do about that? Those are the types of things that we're going to go through. So before we get to the harvesting portion, let's just talk about how capital gains are assessed. So it's really, really simple. If you made a capital gain, which we'll define in a second in terms of how you really calculate that and size that, you basically look up the tax rate that you pay on that, which we'll also go through. And then that's the amount of tax that you owe on a particular security that you've sold. And so this is kind of going to provide the high level framework. I'm going to go through and sort of define, well, what actually is a capital gain? How do I tell what my capital gains are? How do I figure out, roughly speaking, what my tax rate is going to be, my marginal tax rate on those capital gains? And then we can multiply that through to figure out how much money do I actually owe, which is both the direct money that you would pay if you didn't do anything, but also provides an opportunity potentially for harvesting and then saving that money. So all of you guys probably, are able to access a screen like this for your brokerage, assuming that you are invested in markets. You'll go to something like this Fidelity example, and you can click on your positions, and you can see, whether they've gone up or down. The important thing to note in terms of capital gains is you're not actually paying any capital gains on these profit and loss statements. Okay. Now, some of the securities you might have paid capital gains, which is a separate matter, on things like dividends that they've kicked off, or if they're fixed income securities, maybe interest payments. But the fact that you have investments currently in your account that have appreciated or depreciated in value does not mean that you are currently paying capital gains at all. The reason that is because capital gains matter, or they happen when you realize a gain or a loss. And so we'll talk a little bit in the next slide about what that means. But basically, if I take this Fidelity statement and I find my Boeing stock here, I only have to pay the capital gains tax if I sell that security, either in part or in whole. And so I just want you guys to think about, as you consider what your tax burden might be, have you made transactions where you have either locked in a profit or a loss, rather than, when I log into my brokerage or many brokerages, does it say that I'm up or down on a given day? Okay, so capital gains and losses are only generated when the amount is realized, which we just went over. The way that you actually calculate it is it has to do with how much money you've made or lost in aggregate. And there's really two ways to do it. So let me just get my laser pointer out here. You can either think about what's the total value that I sold of a particular stock and subtract the total amount that I paid for that stock or security or what have you. Or you can think about it on a per share basis, which is what is the price that I sold at minus what we call the cost basis, which we'll go over, which is roughly analogous to the purchase amount or the purchase price that you initially purchased it at, and then multiply that through by the quantity. You end up getting to the same place, whether you do it in aggregate or on a per share basis. The cost basis is really important, and so I'll walk through it on the next slide. It's going to be just something that you're going to want to consider, not in terms of necessarily in terms of harvesting yet, but just in terms of thinking about, well, what is my current tax position? How much opportunity is there to harvest? And then one thing I should point out here is that, in Canada, things are actually quite simple. So there's only one type of capital gain. For everyone that's joining here from the US, there's actually two. They're split into long-term and short-term. Long-term is when you've held a security for more than a year until the point that it's been sold. Otherwise, it's recognized as short-term. And so the mechanics and the principles there are roughly the same. The difference is really what the tax rate that you're going to pay on those capital gains are. Okay, so I just want to really quickly walk through this concept of cost basis because it might not be intuitive from the name what it means. And so like I said before, it is basically the price that you entered a security in. And so that is by and large true, except for two things. One, sometimes stocks split. So if you're actually thinking about this, you need to look at the split adjusted stock price. And if you don't know what that is, maybe we can cover that in a Q&A question or something later. But something that happens with some frequency to some stocks doesn't change the value. It just changes sort of what the price that's displayed is and the number of shares that are outstanding. And then the other nuance is that if you've actually bought a security at multiple times, then the cost basis you can think about as an average purchase price or average entry price. So here we've taken like just a chart of the Tesla stock price. And each of these bubbles here is going to represent a time that I bought one share. So the first one, I bought it, roughly 20, and I bought two more at roughly 100, and I bought one more at 300. My cost basis for this transaction is going to be 130, is given by this little weighted average over here. And so I've drawn this sort of average line here. If I sold all those shares at a higher value, I have a gain. If I've sold all those shares at a lower value, I would have a loss. Okay, and so when we're thinking about harvesting, it's really important to know the cost basis of your initial purchases so that you can understand, well, was I actually up or down? Because what we're going to be doing is we're going to be matching these up against each other in order to mitigate any taxes that we have to pay. And so again, if that is unclear, don't worry, we're going to walk through some more examples, but I just want you guys to understand this terminology. I should also mention that the easiest way to get the cost basis is actually just to look at your brokerage, or use some tool that pulls in data from the brokerage, because they'll calculate this for you. It'll be split adjusted, but the concept is really important to understand so that as you're making investing decisions, like what should I expect from this sort of investment in terms of taxes, if it goes up or down. That's kind of the concept that we want to drill in. One last thing on this is, do you prefer a high or low cost basis? As an investor, obviously you want a low cost basis because that means you bought low and sold high, means you made money. For taxes, it's kind of the opposite, right? The better investor you are, by and large, the more you're going to have to pay capital gains tax at some point. And so just bears mentioning that, these things are neither good or bad. It just kind of is what it is. And it's useful to take stock of what the current situation is, understand how it works, and then think about matching them up throughout your portfolio.
And Reed,
Yeah.
Danny had a question. Does cost basis include fees?
So I don't think it does. I'm not 100% sure, particularly as it pertains to Canada, which is, I think, where most people are joining. The fees are usually a very trivial amount of the sale, but that is a good question, and we can definitely get back to you on that. You'll see a lot of the time here, what I think is important is getting it like 90% right, and then having a little bit of buffer. That's definitely one place that, we'll talk about later, that maybe it makes sense to just over harvest a little bit or, do a little bit of rounding, but I don't actually know if the fee gets counted or not. But thanks for the question, Danny. Sorry. So anyway, that's roughly how you get, just to go back to this equation, that's how you get the capital gain. You're going to want to multiply that by the tax rate that is relevant to you, and then you'll get the tax owed. And so in Canada, where again, I think most people here are joining from, it's basically just based on what your normal income tax rate is. Again, I'm American, so, you guys probably know this better than me, but the way that the capital gains work is just 50%, what they call an inclusion rate on that. So if you're in this middle bucket here, making, 100K to 155K a year of just ordinary income, and your rate is 26, then your capital gains effective rate, or your marginal rate on capital gains, is 13%. And so just to, again, like hammer home a example, this one's a little bit more complicated, so just bear with me. If you bought 250 shares of Tesla and then you sold 80% of them, okay, and your entry price, just one entry price, so that makes it your cost basis, is 275, and your exit price here was 380. Okay, what we're going to do to calculate the capital gains and then the tax owed is, first we're going to get the gains, which is the price that you sold it at, 380, minus the 275. You're going to multiply that by the number of shares, but it's important to note it's only the shares that you've realized on a sale. So even though I initially had 250, it's just this 200 number, I still own 50 that are floating around. They might go up, they might go down. I have no current capital gains on those. If you multiply that through, you get to 21K capital gains. And then to get to the taxes that you owe, you multiply that by this rate. So which is the 50% inclusion rate times your tax bracket rate. So in this case, if you made this transaction over here and you did nothing, no harvesting, no anything, you'd owe $3,000. That's going to be, to start off with, the thing that we're going to try to get rid of as we go through. Make sense? The US is more complicated. Basically, you have short-term and long-term, and then you have this web of, filing statuses and different things where you have to look up your rate. We have a blog post on this where, you can find stuff like this table here, which is for long-term. The thing I'll say about the US is, if you can, you generally want to only realize long-term capital gains, because the long-term rates are a lot more generous than the short-term rates, which are your ordinary income rates. And so it's quite punitive to hold something for less than a year, sell it at a gain, and have to pay out a lot of taxes when you would have rather potentially held it for longer. But if you've sold it at a short-term gain, you can always do the harvesting that we're going to talk about to try to mitigate that. Okay, I see some more questions coming in. Ben, is there anything that you want to bubble up here just while I'm going through?
Yeah, just one question, and I think this is something we covered off in the blog post as well, but I know when it comes to the cost basis, Daniel had a question. If you bought stocks in several points for different prices and you sell only some of them, how can you make sure to sell a price for more expensive transactions?
Yeah, so in the US, where this is really the only place that I know how this works, Canada, I'm not 100% sure. In the US, before you sell something, you have to contact your broker and you have to elect either FIFO or LIFO. And that's some accounting speak for first in, first out, or last in, first out. By default, it is FIFO, meaning that the first things that you bought will be the ones that they use the cost basis for. And that's good and bad, basically. It's good because if you're a US investor, it's more likely that it's a long-term capital gain, which is, I think, why they set it up that way. It's bad because it's going to probably have a lower cost basis if the security is appreciated over time. And thus, you're going to owe more taxes at a lower rate. So if you really want to get into the weeds of it, you can talk to your broker before you sell it and instruct them on what accounting methodology you want them to use when you make a transaction. I have never done it myself, but it's definitely something that you can do. And if I lost you, there's a FAQ section of the blog post there that has a question about that. It might be one of the first questions there, because it's a good one. Yeah. Cool. Okay. So this is kind of the last example and the most nuanced one, but I just really want to make sure that we kind of fully appreciate how the gains work, and then we're going to follow through on the next slide to talk about how to harvest. So we're going to get to the point where the saving money occurs. So in the last example that we went through, where we're just buying Tesla, we didn't really have any opportunity to harvest because it was really like the only thing that we owned. In this example, I want to make a slightly more nuanced or slightly more detailed portfolio where we have two holdings. And so just posit that you bought 250 shares of an S&P 500 ETF and 250 shares of Tesla again at the beginning of the year. So what your portfolio is going to look like, if you guys can see my laser pointer, is this. You've got 120K of SPY and roughly 70K of Tesla. Now, if you had done nothing over the course of the year, no sales, no nothing, unfortunately, the markets have been down. So you wind up with 100K of SPY and 45K of Tesla. Now, if you had made a trade very savvily, right? Like when, for instance, when Elon was talking about buying Twitter, and you thought, well, maybe Tesla's going to go down because he's going to have to sell a bunch of his shares or something like that. Let's say in April, you sold 80% of those shares. Okay. What you will have done is you will have locked in this capital gain here. And it's going to be, in the US, it's going to be short-term capital gains. In Canada, it'll just be regular capital gains of $21,000. Then play the movie forward to the end of the year. This is kind of what our aggregate holdings look like. Okay. We have the same amount of SPY that we had before, but because we've made some trades, we have a little bit of Tesla left. We have a bunch of cash from the sale of the Tesla stock, and that cash is $76,000. But unfortunately, 5% of that is actually owed to the government because we basically have a naked capital gain there with no offsetting losses or anything like that. And one thing to note here is that it's even more unfortunate because your portfolio value has gone down over time, right? This is a classic tax loss harvesting situation where not only have you lost money in an unrealized sort of way because the stuff that you've been holding has gone down, but you've also locked in a gain through what is, honestly pretty good trading, right? You basically called the top of Tesla and you sold 80% of your stuff, and yet you still owe money, right? So that's what we're going to try to rectify in the next slide. So the important thing to remember here is 21K gain. We made one trade, some stuff went down. We're going to go on to the next slide and talk about harvesting. The clicker works. There we go. So what we can do is, if you realize that we have this $100,000 SPY position, it's actually $20,000 down from when it started. And so that is an unrealized loss, right? If we're able to convert that to a realized loss, then we have this $21,000 netting with the $20,000. They literally offset when you do your taxes, and then you only owe the taxes on the $1,000 residual. So in this case, you could just sell SPY and it would have the effect of negating your taxes, but your portfolio would be, somewhat different than you probably wanted, right? Like presumably what you're holding is closer to the portfolio that you want than the portfolio where you actually just remove $100,000 from the market, which is kind of extreme in order to save $5,000. So what harvesting is it's taking that situation here that you're left with, and it's swapping out, basically selling this SPY security for something that is substantively similar, like, for instance, VTI, which is another ETF that is basically the same exposure. The idea is that even if you're a little bit less happy with VTI, which you probably shouldn't be because they probably look almost exactly the same, that you'll have locked in this $5,000 gain. And in investing, there's usually nothing that is quite that good as the free $5,000. Okay, so in this example, we have two securities, right? And I promise I'm going to stop throwing numbers at you guys. So we can share the slides too, and you can go through them or can answer questions about the particulars of the math, if we need to. But the concepts are really what I want to hammer home here as well. And the first concept is, let's say I don't just have SPY, let's say I have other things that have gone down in value. How do I decide which one to sell? And so we think that it's best to think about this in terms of like three sequential questions. The first one is, are there things in my portfolio that I don't actually really want exposure to anyway? If so, you should definitely do those trades before the end of the year, lock in the loss, figure out how much gain you have left, and then sort of do that iteratively until you have at least matched the amount of capital loss that you've realized with the amount of capital gain. So then, assuming you go through and you're like, actually, this is the portfolio that I want, there's nothing else really that like I can sell, quote unquote, for free in terms of how happy I am with my portfolio. You want to go through and look for securities that are easily replaceable. And so this is where we get into some nitty gritty here, because there's something that I'm going to talk about in a second, which is called the wash sale rule, or in Canada, it's called superficial loss, which says that it can't be the exact same security. So if we go back to this example, what I can't do is I can't sell, my SPY ETF, wait a day and go, okay, I'm ready to have it back again. I locked in my loss. I'm going to buy it back the next day, because that won't count. And if you try to file that, you'll be breaking the rules, basically. But what you can do is you can find something that is substantively the same, at least to you and your investment strategy, but is not exactly the same. And so again, we'll talk through in the next slide what qualifies for that and how to navigate that sort of trade-off and that balancing act. But that's really, when people talk about tax loss harvesting, that's really often what they mean, which is locking in losses and then moving your portfolio back into a position where it is basically the same as you wanted it, but just without having to pay the taxes because you mitigated the gains with some losses. Assuming that you've gone through those two questions and you can't really find anything else, you do have the option of selling something, waiting 30 days so as not to trip this rule, which again, we're going to talk about in a second, and then buying it back later. Whether or not you want to do that is a little bit more your discretion. It's less of a clear win. Often, I think, personally, it makes sense because, saving money on taxes is mostly risk-free. And it's tough to say if whatever security you are going to hold is going to do well over the next month or not. But it's really up to you. And it depends on your specific and personal circumstances about whether you want to sell something and wait. Couple other things that are important. So the timing of this. So taxes are assessed on a calendar year. The important thing to note is it doesn't just have to do with when you make the trades. So if I want to tax loss harvest this year, even if I go and make a bunch of trades on like the last day of the year, it has to do with when the trades settle. And so settlement varies a little bit by security. In general, most stocks are 2 business days. Most ETFs and mutual funds are between 1 and 3. I believe that's true for Canada as well, and those exchanges. But we recommend that you take action at the latest, like the second to last week of the year, because there are going to be some holidays. There's going to be some settlement time. It just makes sense to sort of put your house in order before the last minute so that you get credit for the losses and you don't have some technical miss like that. Okay, so the wash sale rule, super, super important detail to know about. So basically the IRS and the CRA prevent you from receiving tax benefit if the same investment is purchased within 30 days of sale. And so we went through one example about how that might work in the situation where you had sold the SPY stock and the ETF and then bought it right back. If you're thinking, oh, I'm really clever, maybe I'll just double up on my exposure the day before and then sell, so that that doesn't work either. It's a symmetrical window. So 30 days before, 30 days after. And then there's a couple other things to note, which we'll go through on this slide here. So this is a framework from BlackRock. And so I think it's relatively reputable in terms of how you sort of base your decision making. The key thing to know is that, the IRS and the CRA are somewhat vague about what actually counts as a wash sale or a superficial loss. And so one of the ways to think about it is there are some securities that have very low risk of, in an audit or something like that, actually triggering, breakage of the rule. And there are some potential swaps that have higher risk. Okay. So things that are like definitely okay, selling one stock and buying a completely different stock, right? Like if I sold Microsoft and bought Apple, definitely okay. Whether that fits in your portfolio or that's what you want to do is another question. What tends to be not okay, and then everything else is just sort of different degrees. What tends to be not okay is to sell an ETF and buy something on the exact same index. So one of the reasons that we chose VTI in the example that we gave is it's actually a different US equities index, even though the the macro exposures and the rough, characteristics of how it's going to perform are relatively similar. It's a different index, which gives you some protection in looking like you're just gaming the system. Other things that are okay, if you have an active ETF or active mutual fund, I'm going to sell that for a passive one. Even if it's, on the same index, you'll probably find other things that are not okay, like trying to get too cute with it, like selling a single name stock and then buying an option on that same stock to like basically replicate the exposure or using some other derivative, probably not okay. And so again, this is linked in the blog post, this chart here. I think it's helpful just to think through different options that you have, but really important to keep in mind just in terms of not actually breaking the rules. Couple other things that are important to note here. And if you remember back to the beginning when I talked about how sometimes your tax-free accounts do matter, it matters for this, which is that you can't use them to preserve your portfolio exposure. A la the following example. If I sold my SPY stock in my normal brokerage account and then I bought it back the next day or the same day or whatever within 30 days in my tax-free account, well, that's clearly skirting the rules, so it's not allowed. If you have a spouse, you can't use them to like put back the exposure, assuming you're filing together. That's not allowed. And then one last note, which is, for self-directed investors, but who may use things like robo-advisors, important to note is that you can also trip this rule if somebody's trading on your behalf. Personally speaking, it's one of the reasons that I like to manage my portfolio myself, so I don't have to worry about this kind of thing. But for instance, if there had been a trade in my, robo-advisor in this VTI stock, then that would become something that I wouldn't want to use for my tax loss harvesting. And then one more point of clarification is that everything I'm saying about it not being allowed, it's not allowed for tax offsetting purposes. You can always buy and sell. I can buy Apple, sell Apple the next day, buy it back the next, et cetera, et cetera. I just can't claim it in my tax, forms as, offsetting capital losses or on gains if I do that. So it not being allowed, it's not allowed for, tax loss harvesting purposes. You can still do it. It's just not going to be very tax efficient. Okay. I see a lot of bubbles here. Are there any common threads that are worth addressing before we move on, and then before we get to the Q&A, Ben?
I think we've answered all of them. One of the questions Danny just had was if both him and his spouse own the same stock and they both sell all the units on the same day, are they okay?
Yeah, if you're moving the same direction, you're fine. It would be the thing that you don't want to do is, basically blatantly skirt the rules. So for instance, if you think about your spouses and your accounts as one account, and whatever you want to do is fine. If it was one account, it's fine to do as two. The thing that I'm trying to say is that what you can't do is if you sell a stock and you want to lock in that loss, and if it was just one account, you weren't allowed to buy it back the next day and still count it as a loss, then you can't go and do that in your spouse's account and be like, don't look at my spouse's account, just look at my account. I'm doing the harvesting over here. That's skirting the rules, and that's what you can't do, if that's clear. Okay. So the scenario that we just went through, and again, no more numbers and examples and such, we're just going to talk concepts from now on, is at the most sort of traditional or common harvesting example where you have locked in gains. Now, it might be the case that all of the transactions that you've done over the course of the year have locked in losses. Totally fine. Doesn't mean your portfolio is down. Doesn't mean you're a bad investor, whatever. There's basically two things you can do in that circumstance or that situation. The first thing is you can know that you have losses and you can feel free to rebalance your portfolio up to a point to get it to where you want to go. Knowing that this thing I've always wanted to pare down, the size of this security that's gotten quite big in my portfolio. but I haven't done it because I didn't want to pay capital gains. You can do that knowing that you have losses offsetting it. So it's sort of the same idea, just in the reverse. The other thing that you can do, which is actually quite powerful, is you can deduct or carry forward losses. So in Canada, for instance, if you've actually paid capital gains in the past 3 years, and like because you had on net gains and you were taxed on those, you can realize your losses or just not do anything in this situation because you already have them. And you can retroactively use them to offset your previous 3 years of gains up to however many losses that you've locked in. Again, I am not an expert on actually doing the filings. So I don't know, which box you check to do that in Canada, but that is something that you want to consider from your investment portfolio and your strategy of like, oh, these are actually quite good to have for me in my situation because I can use them retroactively against the capital gains that I paid before. In the US, there's something that's even maybe nicer, which is that you can deduct up to $3,000 of net losses. So, if you have more losses than gains, those are net losses. And by the way, there's different categorizations, but that's for individuals or married filing jointly. And that gets deducted out of your ordinary taxable income. So for instance, if you were paying 33%, just to make the math easier, effective tax rate, then if you were able to max out this deduction, you'll save $1,000 just by having $3,000 of losses this year. And so in both countries, you can also carry these forward indefinitely. So as long as you keep track of them and you do the paperwork, come next year, if you have gains, you'll have sort of pre-harvested those gains. And if you're in the US, for instance, you can just keep deducting up to $3,000 until they change the rules. The other thing that I wanted to mention is that if you're in the position where you do want to rebalance, it is worth thinking about taxes as well, sort of outside the scope of this talk, because we're mostly talking about end of year harvesting. But there are some things you can do, like if you have something that's spitting off a lot of interest and dividends, you're going to want to move that to a tax-free account if you can. You're going to want to organize your portfolio so that riskier investments in general are in your taxed accounts so that you can take advantage of harvesting going forward in subsequent years. So there's a lot more to be said on that topic because, taxes it's a big surface area. But as you think about rebalancing, given that your head is in taxes, you might also think about how to structure your portfolio to be tax efficient as well. And then this is not like a totally mutually exclusive framework, but let's say you haven't sold anything, you have some stuff that's gone up and down. It's going to look a lot like these other situations in terms of the principles. If you do want to rebalance, just make sure that when you do rebalance, you're matching your gains and your losses before the end of the year. So you don't, rebalance, then wind up with gains and then be like, oh, I should have harvested those. And you can over-harvest a little bit if you so choose, maybe because you're in Canada and you've actually paid capital gains in the last couple of years, or because you're in the US and you want to max out that $3,000 deduction. The last thing I'll say, like personally speaking, I think it makes sense to over-harvest a little bit because there are situations where, you might not get everything precisely right. There's even sort of weedier things that can happen, like you can be holding a mutual fund that gives you a capital gains distribution right at the end of the year that you didn't know about. And it would have been nice to have a little bit of losses that you're just carrying forward, assuming that you can get them through harvesting. You don't have to radically change what you're doing in order to offset those. Okay. That is mostly the overview that I wanted to get through. I'm going to kick it over to Ben, who's going to just really quickly take us through some of the stuff and the infrastructure that we're putting together to try to make this a little bit more streamlined for everyone, myself included.
Yeah, thanks, Reed. This is really helpful. And I think it's one thing that as we started looking into this, we were just like, this is something that has a potential to save a significant amount of money each year doing this. And I think one of the things that we realized as we were looking into this and seeing what else is available, that there isn't a tax loss harvesting tool that's available for self-directed investors. Like Reed had mentioned before, usually this is something that has been, something a wealth manager does, or I know that there's robo-advisors that advertise this as a feature. And so we were really excited to build a tool into PortfolioPilot. And just like the entire platform, this is a free feature for every individual investor to use. So, we're, of course, we just launched this on December 1st, and we're really excited to just get feedback and, and get people using this, because I think it's really helpful, especially in a year like this. So one thing just to kind of go over this tax loss harvesting feature, just like PortfolioPilot is, we have everything in one place. So what we're using is your connected accounts to pull in not only what you've sold, but the metadata on cost basis and things like that. The other thing in this, and we'll get into this next, is just like also giving people a view of where there are opportunities within their portfolio to harvest. And then also just a clear picture of the savings and understanding your approximate tax burden and things like that. So let's go ahead and dig in. So we've organized this into 3 sections. And just to go back a little bit, as you can see, as everyone that's familiar with or has used PortfolioPilot, on the left side, we've added a new section called taxes. So if you click that, it takes you to this main screen. And again, we've separated this out into 3 sections. So at the top, you're going to have estimated taxes and rates. The middle section is going to show your sold securities. So it's actually pulling in securities you've sold from any of the accounts, your brokerage accounts that you've connected. If you have not sold anything this year, this section will be empty. And then the last part is that we've included recommendations for tax loss harvesting. So we are offering up securities that are already in your portfolio that you might consider selling and replacing if you desire to kind of lower your tax burden. So the first section is, and I just wanted to go back to this, is updating your investor preferences. One of the things that we do, and again, if people are familiar, as you're onboarding, we're asking you some questions about yourself, such as what your income is, how you file your taxes, whether it's single or jointly. That really mostly applies to the United States. And then also, where your tax residency is. So that is where this information is coming from. But if for some reason anything has changed since you signed up, by clicking that edit button, you can actually see the breakdown of how we've come up with these, your marginal short-term rate and your marginal long-term rate. Just to preface, this is for the United States, not Canada. It's, again, as Reed mentioned earlier, much simpler. But if anything has changed, by clicking that update investor preferences, will take you to your settings, and you can update these numbers, and then by saving it, it'll update this screen. The next piece of this is just this section on sold securities. Again, this is going to just give you a breakdown of taxes that you might owe. This is the United States example. So as you see, you're going to see the short-term capital gains tax for each of these sold securities, or the long-term capital gains as well. So this is just kind of, again, if you have not sold anything this year, this is going to be empty. If you have information coming in from robo-advisors that you might have connected or anything like that, you'll also just see a notification that just says that this is incomplete data. One thing we just like to note as well is that, we're not monitoring the watch sale rule for you. Of course, we want you to be aware of that, but that's something that, at this moment, we're expecting you to monitor and to as you move forward with your tax.
Yeah, and one of the reasons that it's just so unclear, exactly what is a hard and fast thing that is okay versus not okay, that, we want it to be mostly up to the user in terms of what you're comfortable with. That being said, everything that we described is done with robo-advisors and is pretty standard. So you should be fine if you follow sort of the guidance that's been laid out. Okay.
And then this next section, I think, is one of the things that is really helpful because not all of us have someone like Reed to call all the time. But this is just an area where it's recommendations for tax loss harvesting. So these are suggestions or opportunities that we think will help with that are related to your sold securities. So as you can see on the right side, there is a place where you can add, you can edit any of these if you already own it. So if, for example, if you were to click add, you'll end up going to a screen, a pullout that looks similar to this. So it'll show you the current amount that you own. Then it'll also show you the potential tax credit. This is also an opportunity where you can go in and you can, choose how much you want to sell. And in any case too, if you wanted to do a replacement like Reed had shown you regarding the SPY and VTI replacement, this is also someplace where you can go in there and just type in the ticker or the name. It'll auto-populate and you can select the amount. If you're thinking you want to replace and you aren't sure what types of securities that you could replace it with, we also have this section where you can just search for similar ones.
Yeah, just keep in mind, can't be too similar.
And then the last piece, again, like one of the things that we love and one of the things that we love building into PortfolioPilot is the draft portfolios, which allows you to experiment with different investing strategies or adding or buying or selling different securities. And so one of the things that is great about this is you can see all of this in one dashboard. If this is something, again, you can go back and edit or add. But one of the nice things is that after you've done all this work, you can actually click at the bottom of the screen the create order execution list, which will provide you a list of what you need to buy and sell. And then you can go and log into your brokerage account and make those trades. For everyone that is not familiar, and I just want to preface this as well, because we are a read-only platform, meaning that we do not make trades on your behalf. There's a few things, it makes it safer for everyone to use and not the fear of accidentally doing something that could affect your portfolio. But the also nice thing is that this way you can experiment without actually trading. So yeah, that kind of wraps up just a summary.
Yeah, just one other thing to mention maybe there is that out of the things that I've talked about also, we're not really capturing deductions. So if you do want to consider that, take this as a framework, but feel free to do things like over harvest a little bit, based on your own personal preferences. And hopefully we'll build in some of that stuff going forward. We would love feedback. We want to hear if this is kind of stuff that is useful to you. And then we'll iterate on it for next year, and we can save everyone some money, hopefully from now until then.
And just, I just wanted, Daniel, I know you just asked a question regarding, do we calculate the fees? So we don't calculate the fees of trading.
Okay, so I can talk about trading costs a little bit. So if you want to email us, I can send you, there's a rough way of calculating how much transaction costs will be for any security that we kind of use in the industry. And it's basically based on, what the volatility of the security is and what the trading volume is. And so you can look at that to figure out kind of what your break even is. My best guidance for you is that if you're trading something that is big and liquid, like, commonly traded ETF or something like that, the transaction costs are not going to be prohibitive. The only time you really need to worry about it is if you're like a really big holder of a small cap stock. You should think about, is there something else that I can use for harvesting, or maybe not doing it at all if you think you might move the market. But for most retail investors, you really shouldn't have to consider it, because the tax benefit will probably predominate. But feel free to, and this gets us to our sort of next slide, I guess. Feel free to reach out. And if you have specific questions like that, you can type in support@globalpredictions.com. You can email Ben. He'll make sure it gets to the right one of us. And I'm happy to give you some sort of insights on how to think about transaction costs or that sort of thing.
Yeah, and yes, and just to answer to Adam, I know you just asked, this is available in Canada. So by logging into or signing up for PortfolioPilot and going through the onboarding process, you'll see the taxes feature. It's available to everyone right now. You'll see it in the left-hand toolbar. And again, like if you have any questions, reach out to support. If you, as we said, this is something that we just have launched and are always looking for user feedback. It's been super valuable for us. Please reach out to me. We can always set up beta testing sessions or feedback sessions as well. The other piece of this as well, if you're new to PortfolioPilot or if you just want to dig into a specific feature, every week we offer an orientation session and we offer a deep dive session. They are just like this, they are completely free. Sometimes it's a smaller group, so you can almost treat them as office hours and come with specific questions. And sometimes too, we also just kind of review specific areas of the product. But we will send just a follow-up email with the blog post link. And then we will also, I'll just include a link to these sessions and you can check the calendar and join one if you're interested. Does anyone have any other questions before we end? Cool, I think we did our job then. The last thing I just wanted to do is thanks everyone for joining this. We're really excited to get this in everybody's hands. And, again, please reach out with any questions.
Yeah, thank you all for your time and for your questions and your interest.
Cool. See you guys all later. Thank you.